Performance measurement is a fundamental component of management accounting that enables organizations to evaluate the extent to which strategic objectives are being achieved through the efficient utilization of resources. Modern performance measurement extends beyond financial profitability to include operational efficiency, customer satisfaction, innovation, sustainability, and regulatory compliance. Effective performance measurement systems provide managers with timely and relevant information for planning, controlling, motivating employees, and supporting strategic decision-making. Consequently, organizational performance should be assessed within the broader context of mission, strategic objectives, economic conditions, government regulation, and sustainability considerations. Mission statements and their role in performance measurement. A mission statement is a formal declaration of an organization's fundamental purpose, values, and long-term aspirations. It communicates why the organization exists, the needs it seeks to satisfy, and the principles that guide its operations. Unlike short-term financial targets, a mission statement provides a stable strategic direction that influences all managerial decisions and organizational activities. Mission statements play an essential role in performance measurement because they establish the framework against which organizational success is evaluated. Performance indicators should reflect the mission by measuring whether organizational activities contribute to achieving long-term objectives rather than simply maximizing short-term profits. For example, an organization whose mission emphasizes customer service excellence should include customer satisfaction, service quality, and complaint resolution indicators alongside traditional financial measures. Similarly, a mission focused on innovation should evaluate research productivity, product development, and technological advancement. Thus, the mission statement ensures that performance measurement remains aligned with organizational purpose and strategic direction. Furthermore, mission statements enhance communication, employee motivation, and organizational culture by providing a shared understanding of corporate priorities and expected behaviors, thereby supporting consistent performance across departments. Strategic, tactical, and operational objectives. Organizations translate their mission into a hierarchy of objectives that guide managerial activities at different organizational levels. Strategic objectives represent long-term goals established by senior management, typically covering periods of 3 to 10 years. These objectives focus on competitive positioning, market expansion, technological leadership, profitability, sustainability, and shareholder value creation. Strategic objectives determine the overall direction of the organization and provide the foundation for performance measurement systems. Tactical objectives support strategic objectives by translating long-term plans into medium-term departmental targets. Middle managers develop tactical plans concerning production capacity, marketing programs, workforce development, resource allocation, and operational efficiency. Tactical objectives ensure coordination between strategic ambitions and daily operations. Operational objectives are short-term targets concerned with routine activities such as production schedules, quality control, inventory management, labor productivity, and customer service delivery. These objectives are monitored continuously through operational performance indicators and management reports. Performance measurement systems should therefore incorporate indicators at all 3 levels. Strategic indicators evaluate long-term competitiveness and profitability. Tactical indicators monitor departmental performance, and operational indicators assess day-to-day efficiency. Alignment between these objectives ensures that individual activities contribute directly to overall organizational success. Impact of economic and market conditions on performance measurement. Performance should always be interpreted within the context of the external economic and market environment because many organizational outcomes are influenced by factors beyond managerial control. Macroeconomic conditions such as inflation, interest rates, exchange rates, unemployment, economic growth, and recession significantly affect sales volumes, production costs, financing expenses, and profitability. For example, rising inflation may increase material and labor costs while reducing consumer purchasing power, thereby influencing organizational performance independently of management effectiveness. Similarly, market conditions, such as competitor behavior, technological innovation, Changing customer preferences, industry growth, and supply chain disruptions may affect organizational results. Declining market demand may reduce sales despite efficient internal operations, while favorable market expansion may improve profitability without significant managerial improvement. Consequently, performance measurement should incorporate benchmarking, industry comparisons, market analysis, and economic indicators to distinguish internal management performance from external environmental influences. Managers should be evaluated based on factors within their control, while recognizing the impact of broader economic conditions on organizational outcomes. Impact of government regulation on performance measurement. Government regulation has an increasingly significant influence on organizational performance measurement. Businesses operate within legal frameworks governing taxation, environmental protection, employment law, consumer protection, competition policy, health and safety, financial reporting, and corporate governance. Compliance with regulatory requirements often imposes additional operating costs, but simultaneously reduces legal risks and enhances organizational reputation. Performance measurement systems should therefore include indicators assessing regulatory compliance alongside traditional financial metrics. Examples include workplace accident rates, environmental emissions, product safety standards, financial reporting accuracy, employee welfare compliance, and adherence to industry-specific regulations. Failure to comply may result in fines, litigation, reputational damage, operational restrictions, and loss of stakeholder confidence, all of which adversely affect long-term organizational performance. Consequently, effective performance measurement extends beyond profitability to include legal compliance, ethical behavior, and corporate governance standards that support sustainable organizational success. Impact of sustainability on performance measurement. Modern management accounting increasingly recognizes sustainability as a critical dimension of organizational performance. Sustainability refers to meeting present organizational objectives without compromising the ability of future generations to satisfy their own economic, environmental, and social needs. Traditional performance measurement focused primarily on financial outcomes, such as profit, return on investment, and cost control. Contemporary organizations, however, increasingly adopt the triple bottom line approach, evaluating performance across three dimensions: economic performance, including profitability, productivity, and shareholder value; environmental performance, including energy efficiency, carbon emissions, waste reduction, resource conservation, and pollution control; social performance, including employee welfare, diversity, community engagement, customer satisfaction, and ethical business conduct. Sustainability indicators may include greenhouse gas emissions, renewable energy usage, recycling rates, employee training hours, workplace safety, supply chain ethics, and corporate social responsibility initiatives. Integrating sustainability into performance measurement enhances stakeholder confidence, strengthens corporate reputation, supports regulatory compliance, improves long-term competitiveness, and reduces environmental and social risks. Increasingly, investors, customers, employees, and governments expect organizations to demonstrate responsible business practices alongside financial success. In conclusion, effective performance measurement is a multidimensional management process that aligns organizational activities with mission statements, strategic objectives, operational performance, economic conditions, regulatory requirements, and sustainability principles. By combining financial and non-financial performance indicators, organizations can evaluate success comprehensively, support informed managerial decision-making, and promote sustainable long-term value creation in an increasingly complex business environment.